Well, good afternoon, macro students. I'm here today, Tuesday, March 31st, um, to give a short lecture on, I believe it is topic 19. For those of you who joined me yesterday on Collaborate, we went over this quite extensively. So I'm just going to do a short synopsis here, just so that those of you who were not with us can understand how to do the homework. So basically, I'm turning this topic 19 into a homework assignment, which will be due next Monday, I believe. And the homework assignment does have different numbers than this topic, but the method by which you will solve the questions will be the same. So let's get going. I'm going to go to our course first, and let's see, there it is. Let's open it up. You know, it might be interesting to open MindTap Apply up, and let's open the Cengage MindTap Apply up here, just out of curiosity, to see what's happening with it. And what I wanted to check is to make sure that I changed all the due dates from here on out for this class. I think I set them back to, let me just think. I want to check the calendar here. May 13, I believe, in this class. Let's check that out. I think I can see them by date, and interactive book. Gosh, it looks like there's some due today, right? On the 30th. Practice, adaptive test prep, classical macroeconomics. All of these were practice. Okay. 014. There are actually some due. Nope. Interesting. Okay. So it should be in the last week, the 17th week, that they'll be all due. 65 activities. Wow. Yeah, you can see now all the ones with the red dots are there. So really, we're covering this business right here. I hope you get in and do those homework assignments, even though they're not due until towards the end of the semester. But I just didn't want to deal with the whole change in the dates and the deadlines every now and then. I decided just to push them all back to the end of the semester. These homework assignments will still be worth, what did I say, 18% of the grade at the end. But it looks like I did push them all to the end of the semester from here on out. Well, that's good. Let's open up the lecture topics now and take a look at those. So exam 2, open in a new link. Wait for this to open. Oh, it's taking a while. Come on. Well, okay. So here's 19. And this is the homework assignment, except all the numbers will be different. And I see here I had 2007. I think that's correct. The homework assignment. Now let's go to take a look at that very briefly. So written homework assignments. And here is, I wonder why it went directly. Oh, I don't, I have the edit button off. So it's not showing the other ones. But here's written homework number 3. And you can see the numbers are different. And this data is from 2017, just really 2 years ago, since they haven't even gotten all of the 2019 completely ready for publication. And so all of these all of these questions need to be answered for the homework. It is due on Monday. It's assigned on Monday, yesterday, March 30th, and it's due by Monday, April 6th. Is that right? April 6th. That's correct. All right. Good. So back to number 19. And basically, I think we're going to find this handout. Let's open it up. Open in a new link, GDP. It's still isn't loading. Come on. Oh, I'm not sure why that's not loading. Oops, there it is, I think. Nope. Let's go to another place. I know I have it somewhere else. I think under PowerPoints. If we go to PowerPoint presentations and to number 19. Hey, by the way, here's the lecture over 18. And here's 19. And here's the one I was trying to open. This one will not open for some reason. Let's see if this one will. Yep, open immediately. I don't know why the other one didn't. So just to review, this question 19 basically is asking you to figure GDP. And up here in 17, we saw that we could figure that out in 2 ways, by using the expenditure approach or by using the income approach. And so this handout that I just opened up shows the expenditure approach up here, the C plus IG plus G plus X minus M, that is household consumption, gross business investment, government expenditures for goods and services, and net exports, exports minus imports. The other approach is the income approach, a little bit more complex, and you can see that in this approach we add up all the sources of earned income, wages and salaries, rent, interest, corporate profits, and proprietors' income in order to get national income, which is all earned income. If we then add the indirect business taxes to that, which just basically means, as we said in class, excise and sales taxes, we get net national product. And it's not net domestic product because, because this is the income approach. And basically GNP is income and GDP is the value of the goods produced. So then once we add indirect business taxes, we get net national product. And then to that, if we add depreciation, we get gross national product. To go from gross national product to gross domestic product, we need to subtract all the income that citizens of the United States earned from abroad, whether they be working there or whether they are earning profits or interest there. So those are subtracted. And then we have to add the income payments United States corporations and governments made to people around the rest of the world, foreigners, in the form of wages and salaries, rent, interest, and profit. And by doing that subtraction and addition, we get to GDP. By the way, we'll see what in this problem, if we reverse this, if we subtract income payments to the rest of the world from GDP and add income receipts from the rest of the world to GDP, we'll get GNP. So you can move backwards and forwards. And that's what's going to be happening in this problem quite a bit. But anyway, this is the income approach. As you can see, it's much more difficult to calculate it because it has so many different moving parts than the expenditure approach. There was a third part here in this handout that I didn't go over. I hadn't given a lecture before spring break on this. And basically, what we have in the bottom is the relationship between GDP, net national product, national income, personal income, and disposable income. So we're going to start with GDP. And as I said up here, we're going to add the income receipts from the rest of the world and subtract income payments to the rest of the world to get GNP, which is basically GNP is the total income earned by citizens of the United States in producing goods and services, whether they produced those goods and services here in the United States or abroad. GDP is the value of all goods and services produced in the United States, whether produced by citizens of the United States or from some other country. All right, so that we moved from GDP to GNP. Then we subtract depreciation, which is up here. So we're moving backwards here to get net national product. Then we subtract indirect business income to get national income. So basically, we're just reversing the process we took in the income approach up to this point. But now, once we get to national income, which is all earned income, we're going to bring in some other things like Social Security taxes that people who are working and earning money have to pay. And we need to subtract corporate profits taxes that corporations pay to the government, state and federal. And then we have to subtract retained earnings because those aren't distributed as income and from national income. And then we add personal current transfer payments like Social Security, unemployment compensation, and welfare benefits to get personal income. Now, personal income is income from all sources, whether it's earned or unearned. In other words, is a transfer payment that someone gave them. And really, there's not a great deal of difference between these two, but conceptually, they're different. And then from personal income, we need to subtract personal income taxes, which would have needed to be done by the middle of April if this coronavirus pandemic hadn't intervened and the federal government, President Trump, postponed the due date until July 15. So I'm still going to try to do mine if I have time before April 15th. I don't want it hanging over my head forever. And once we subtract those taxes, we get disposable personal income. So if you're working and get a paycheck, this is your basically, it's kind of your take-home pay because not quite mine. I do have federal taxes subtracted from mine, but that's not the only thing I have. Other things subtracted too. I have to pay for part of my health insurance, to pay for my wife's health insurance, and I have some tax-sheltered savings. I don't know. There's a whole slew of them. I can't remember all of them. There's like 8 lines of deductions. Income taxes are only one. But all those others I voluntarily chose to make. So they are basically like expenditures that I chose to make, except for my paycheck. And except for the tax sheltered savings. And I am taxed on all of those things. Let me think. Am I taxed on the health? No, I'm not taxed on the on what I pay for healthcare. All right. So anyway, back to our story here. Once you subtract your personal income taxes from your gross personal income, you get disposable personal income. And this basically is how much money you have left to spend. You can either spend it or save it, which are the last two items. And you can do personal spend it on goods and services, or you can save it. An interesting thing that I pointed out yesterday is that personal savings is a residual. They don't actually go out and try to measure it. It's just an item that is left over. Whatever it is, it balances the books, if you will. And a lot of economists have wondered how accurate that is, because personal savings, the residual, they do not seem to reflect the increase in the value of assets, even when you take into account, let's say, increased real estate values and stock values. The total amount of wealth seems to increase faster than savings, even when you account for increased values of certain assets. So, yeah, there's something odd going on there. Can't say what. But the important thing here is now we've come full circle. These personal consumption expenditures are the largest item here in the expenditure approach, okay? And so let's take a look at another thing, actually the same thing. If you look under PowerPoints, and this isn't a PowerPoint, but here are the answers. Let's open this link up, and you can see that what I've done here is that the numbers given from the table in 19 are in blue, the answers derived from those given numbers, and the equations below are in red. So you can see that all of the items in the expenditure approach were given, and that's how we figured GDP. In the income approach, wages and salaries were not given, nor was capital consumption. So obviously, you couldn't figure out what NP was doing the income approach. You have to do, and then from there, figure out what GDP is here by doing the addition and subtraction of income payments to the rest of the world and from the rest of the world. So we figure out the first question, A, GDP through the expenditure approach is what this is saying. Then essentially we bring that down here and we add and subtract income payments to and from to get gross national product, which is right here. And then we take that up here and net national product is given in the table. So if you subtract net national product from the answer we got right here, we can find out the capital consumption allowance, okay? And of course, you could work the other direction too. Given net national product, you could subtract indirect business taxes to get national income. Then you could add together all of these: rent, interest, corporate profits, and proprietors' income, add them together and subtract it from this answer, to get wages and salaries, okay? And let's see what other things we can do. So basically, we've calculated national income. We've gotten it up here through this little calculation. And then if we add together these three items and subtract it from national income and then add transfer payments, we'll get personal income. And if we subtract personal, well, I don't give personal income taxes. So, but disposable income is given. So once we have personal income, we can subtract disposable income from it to get personal income taxes. And we can obviously subtract personal consumption expenditures, which are given from disposable income to get personal savings. And here are all the answers that I figured out. But more pertinently, and I think this will be of the most help to you in doing homework number 3, is this. I had just written out all the answers. Like I use the expenditure approach to get GDP. Using these numbers, the homework 3 will be different. I have different numbers. And net exports, they were given up here. And you can see they're negative. And so what are they as a percentage of GDP? Well, they're negative 694.7 over GDP. And this should be negative. I don't know if I can draw in this. Let's see if I can. I don't think I can, but no, I can't. All right. I should have a negative sign here. That's a mistake on my part. And so when you figure out, it should be negative 4.97% or close to 5% here. So then we go from GDP to GNP. And of course, these figures were given, the income to the world, income from the world. And we can get GNP, which notice is bigger than GDP because we're getting more money from the world than we're sending out to the world, mainly income from capital. And then depreciation equals, of course, net investment minus gross investment, but it also equals GNP minus NNP. And since we had just figured out GNP and NNP is given, we get depreciation equaling that. National income equals net national product minus indirect business taxes. And we know that net national product equals 122380.8. That was given. And we know what indirect business taxes were, so we can calculate national income. We know that this is part of the income approach, but we aren't given wages and salaries. So from national income, we subtract rent, interest, corporate profit, and proprietor's income to get wages and salaries. We take wages and salaries as a percentage of national income. National income is here. Wages and salaries are here. So it's 69.64% or nearly 70% of national income. And then we try to get personal income, so we have to subtract Social Security taxes, corporate profits taxes, retained earnings, and add transfer payments to get personal income. And personal income taxes we have to figure out. And we know that personal income, known from here, minus personal income taxes equal disposable income. So if we know personal income and we know disposable income, which is given, we can figure out personal income taxes. And then, of course, we need to figure out personal saving. And so we know that disposable income is split between consumption and saving. We now know disposable income, which was given, and we also know personal consumption expenditures, so we subtract it, and we get personal savings equal 471.8. And then as a percentage of disposable income, we take that number divided by personal income and get 4.6%. And that does it, my friends. That's how this homework 3 is answered. I hope you can jump through all the hoops. If not, visit with me tomorrow at 1:30 on Blackboard Collaborate. All right. See you then.